Hello guys and welcome to another deep value video. Today taking an in-depth look at the Rio Tinto Group, a British-Australian multinational company that is the world's second largest metals and mining corporation. As of the 15th of January 2025, the stock is priced at $60.3 with a market cap of 101 billion. They're trailing at a trailing 12 months PE of 9 compared to their 10-year median PE of 11.5. They have a price to cash flow of 6.3 and a forward dividend yield of 7.41%. The revenue has grown by 25% over the past 5 years. Their net income has increased by 25%. Their earnings per share has also increased by 26.4%. Their common shares outstanding have basically stayed the same. Their balance sheet also looks pretty good. Their interest coverage ratio is 17.85. So basically, they have a perfect, they can easily cover their interest payments. Their quick ratio is 1.15, suggesting good short-term liquidity. The long-term debt equity ratio is 0.21, and their debt equity ratio is 0.23, both showing a low debt load. The cash from operations have slightly budged by 0.2%. The cash from investing has increased by 26.5%. The cash from financing has decreased by 56.8%. Their capex has increased by 29%, and their free cash flow has decreased by 18.8%. Looking at the financial ratios, we can see that the return on equity is 19.5%, the return on investments is 18%, the return on assets is 10%, and the return on invested capital is 13.5%, which is pretty good. Now let's find the fair value using a DCF valuation, a multiples valuation, and the analyst expectations. We get an intrinsic value of $77.7. And using a 15% margin of safety, you get an acceptable buy price of $66, suggesting that the stock at the current levels is a buy. Now, personally, I believe that this is actually a buy. Of course, this is a mining company. Mining companies are cyclical, as you well know. So their multiples and their valuations and their income vary. So a lot of these things are much more because they're cyclical. A lot of these valuations change. So just because they're undervalued doesn't really mean that they're undervalued. If they, for example, have a price to earnings of 5, that may mean that just at the peak of a cycle, and now when they lose their net income after the cycle busts, then their price to earnings adjusts back to normal historical levels. So this might be a case of that, but I don't really think that's the case here, since we can see that their cash flow, their net income, their revenue uh, has been pretty stable. There have been no really not there have been any cycle busts or cycle booms, so they've just basically been growing along nicely. Yeah, and other than that, also trading at a almost 40% margin of safety. So that huge margin of safety can actually guarantee you some assurance that they are not just some value trap. They're also giving you this 7.3% dividend yield, which is pretty nice. And yeah, even if think about this, even if the stock goes sideways, you can still get that 7.3% dividend yield, which is pretty good. And if the stock just grows 2 to 3% per year, then you're already getting a 10% yearly return. So it's actually a pretty good investment in my opinion. Now let's talk about our affiliate for today, Ticker Data. Ticker Data offers real-time financial data on Excel and also Excel templates. So if you ever want to make a DCF, or if you ever want to track your portfolio in Excel, then Ticker Data is the tool for you. You can find it in the description below. They're also pretty cheap, so I think you should check it out. You should see the link in the description to see all of the features of Ticker Data. It's very good. I personally use it, so I recommend you use it too. Also, check out my investing blog featuring in-depth analysis from the link in the description below. Thank you for watching, and I hope to see you in the next video. Bye.